There's a number attached to your life right now. Someone calculated it, filed it, and you probably agreed to it without reading the fine print. Insurance companies don't just guess what you're worth when you die, they have a formula, and it's colder than you think. Let's say you're 35, healthy, making $60,000 a year. You buy a life insurance policy. The agent smiles, runs some numbers, offers you $500,000 in coverage. Sounds generous, sounds safe, but here's what they're actually doing. They're betting you won't die anytime soon, and they're probably right. Because behind that policy is an actuarial table, rows and columns of death probabilities sorted by age, gender, lifestyle, zip code. It tells the insurer almost exactly when you're likely to die. Not the day, but close enough to price you perfectly. If you're a 35-year-old male non-smoker, your odds of dying in the next year are roughly 1 in 1,000, so the company collects premiums from 1,000 people like you. One dies, they pay out. Everyone else keeps paying. The math works beautifully. For them. But here's where it gets uncomfortable. When someone does die, the insurance company doesn't just hand over a check and move on. They calculate something called the value of a statistical life. Economists use it. Governments use it. It's a tool to measure how much a human life is worth in pure financial terms. And the number right now? About $10 million. That sounds enormous until you realize it's not about you specifically. It's about the average person, the aggregate, the mass market version of mortality. Your individual number could be higher or lower, depending on income, dependence, future earning potential. It's economic output dressed up as compassion. The federal government uses this number to decide if a safety regulation is worth implementing. If saving 100 lives costs more than $1 billion, the math says, let them die. Insurance companies use a version of the same logic when they structure payouts. They're not trying to replace your life, they're trying to replace your economic function. And it gets weirder. Some policies include something called an accidental death benefit. If you die in a car crash or a fall, your family gets double, sometimes triple. Why? Because sudden deaths are rarer, more insurable, less predictable, so the company can afford to be generous when the odds are in their favor. But if you die of cancer after a long illness, the payout stays standard. The suffering doesn't increase the value. The formula doesn't care. Then there's the corporate side. Companies buy life insurance on their employees all the time. It's called dead peasant insurance, and yes, that's the actual term some people use. Walmart did it. Bank of America did it. The company pays the premiums. When the employee dies, the company collects. The family? They might get nothing. It's legal. It's common. And most workers have no idea. So what's your life actually worth? If you're insured, it's whatever the actuarial table says you'll cost. If you're uninsured, it's whatever your family can fight for in court. If you're an employee, you might be worth dead to your employer than alive. And if you're just a statistical life in a government database, you're worth about $10 million in theory and maybe nothing in practice. The system doesn't care about your dreams, your relationships, your irreplaceable presence in someone's world. It cares about risk, probability, profit margins. The real question isn't what your life is worth, it's who gets to decide.